So, I'm sure you've heard this phrase or this concept before, right? Pay yourself first. But, you don't really understand the concept or any of the mechanisms behind it. So, let's start here. Let's start with with a question. How much do you have in savings? Do you at least have an emergency fund that's going to cover the cost of a crisis if it happens? I mean, if you don't, you're not alone, right? There was a survey that was done where the majority of Americans don't even have a 250 bucks to spare. Now, that also means that they don't have enough for future expenses or luxuries. Now, it doesn't have to be that way, especially if you follow the strategy of pay yourself first. Now, this golden rule is what can set you apart from people who have to scrape by every month. However, it requires dedication and discipline. You'll have to check your need for instant gratification at the door. You're going to have to get over that. So, what does it mean to pay yourself first? Well, paying yourself first is a pillar of personal finance. Not only do financial planners suggest it, but there are also plenty of books that just repeat and reinforce this. It's even likely that your parents might have given you this advice, maybe not in that wording or phrasing. And the concept is simple. By paying yourself first, you're putting away some cash just for you, whether in a savings or retirement account. Do this before you do anything else, whether it's paying bills, buying groceries, giving your kids their allowance, purchasing, a new TV, a new computer, whatever it's going to be. Thinking of personal savings as the first bill you must pay each month can help you build significant wealth over time. By starting with a small amount, say $100 each payday, and using automatic payroll deductions, you probably won't even notice a withdrawal after a few months. Even if you start out with 25 or $50 a month, you're one step ahead of the game. Eventually, as your salary rises or tighten your financial belt, you can increase the amount you set aside. Now, this strategy is also a good way to pay for planned larger purchases. Do you need new tires for your car in the next 6 months? Do you want to take a really nice vacation? I mean, what about saving for your kids', education, like college? By paying yourself first, you're more likely to have the money for these things when you need it. You won't have to scramble at the last minute. Okay, well, how? How do you pay yourself first? Okay, well, the easiest thing to do is to open a savings account, if you don't already have one, at the bank where you maintain a checking account. This gives you a convenient way to make transfers or deposits as soon as you get paid. Be sure to make it an automatic transfer, either for each payday or once a month, whatever works best for you. The other option is to open an account at an online only bank. These generally offer higher interest rates than brick and mortar banks, and because you can't do your banking in person, you won't be tempted to use the money instead of depositing it. Now, if you have access to an employer sponsored retirement plan, like a 401k, contribute to that instead of a savings account. Your money will accumulate tax free, and many employers will match your contribution, so you'll get a little extra. Now, if you don't have this option, you could set up your own individual retirement account or an IRA. If you're self employed, you could consider a SEP IRA, a simple IRA, or a one participant 401k. You can also check certificates of deposit, right? CDs. And they're going to allow you to put money aside at a set interest rate for a specific period of time, anywhere from a couple months to a few years. However, because CDs usually require a minimum deposit, you may need a larger amount than you would for a savings or retirement account. Also, if you take your money out before maturity, you may not be allowed to keep the interest it earned while deposited. So, thinking about all this, you gotta keep in mind that it's really all psychology, right? It's all about psychology. Now, building savings is a powerful motivator, and there are mental benefits to seeing your balance grow and grow. When you prioritize, your savings, you're telling yourself that your future is the most important thing to you. Also, though money may not buy happiness, it can provide peace of mind because it gives you a greater ability to cope with adversity. Fortunately, when you develop a routine, you're likely to stick with it. The human mind craves structure and a sense of discipline, even if you live on the wild side every now and again. When you start saving, every payday and adhere to that routine, there's less chance that you're gonna stray from the path. So another thing that you're gonna have to do is you're gonna have to deal with those liabilities. Remember not to neglect your liabilities. If you're swimming in credit card and personal loan debt, you need to be practical and get that under control or even pay it off completely before you commit to saving every month. Compare the amount of monthly interest you'll be earning on your savings account with how much you'll be paying in interest, monthly on your debt. If the latter exceeds the former, you should pay off the debt first. You don't want your debt to cost you more money than you save. What does pay yourself first even mean? Okay. Pay yourself first is just the strategy for maximizing savings over time by setting aside a portion of your monthly income in savings before you do anything else with your money. Whether it's paying your mortgage or rent, buying groceries, or acquiring that rare book that you've always wanted for your library. Okay, well, how do you go about paying yourself first? I mean, you need an account, right, in which to do your savings, and you should automate the process so you aren't tempted to spend the money instead. I mean, and there are some circumstances in which paying yourself first might be a bad idea, and you shouldn't do it. I mean, if you're carrying a lot of high interest debt on credit cards or loans, pay those off. Or at least pay them down significantly before you embark on a pay yourself first plan. Otherwise, you could end up paying more in interest on your debt than you earn from, your savings. I mean, potentially putting you even further behind, right? So like we talked about first, deal with your liabilities, right? Then you can start, putting your money to work for you, saving it, putting it, if you feel like putting it in CDs is the best option, putting it in an online savings account or, investing it, which is always the best option. So, now what's the bottom line here? What are we going to take away from this? Like what lesson is this helping us learn? Okay, paying yourself first, it's going to encourage sound fiscal habits. By automatically deducting a portion of your income, you can set the money aside before you rationalize ways to spend it. Still, it's important to be practical. It's no good saving regularly when you have high interest debt because it will only cost you to pay even more in interest over the long run. Do a financial checkup before you commit to a plan. It can save you a lot of hassle and money. For me personally, when I started doing this, I mean, probably 12, 15 years ago, I basically started off doing $50 a paycheck and I got paid bi-weekly, right? Every other week. So $50 every paycheck I put towards, my personal investing account. And over time that built up. And as I started making more money, I changed it from $50 to $75. And then from $75 to $100. And over time, my investment account started growing fairly rapidly until it got to where it is now. So don't think that just because you can only put $25, $50, a paycheck or $100 a month, $50 a month, it's not enough. Over time, it's enough. I promise. It'll get you there. I really hope you guys enjoyed this video. You got some good information out of it. If you liked it, smash that like button. If you're not subscribed to the channel, I would really appreciate it if you did. But until I see you guys in the next video, y'all be safe.